All right, Caleb, this is your 15-minute time frame here. And as you'll see in the live stream I did today with the rest of the public, I was working with the micro, E-mini NASDAQ. All right, so notice this buy side and balance, sell side inefficiency. That was ahead of the 9:30 opening. Then we had these relative equal lows here. That's where sell side is. So notice that the market opened up, traded down, hit the high end of this fair value gap. 2 down closed candles, that's an order block. You can see how we traded down into that and then rallied higher. We're only going to be focusing up until 11:30 noon time each morning, so I'm not worried about the afternoon. All right, so this is the 5-minute chart again. The fair value gap here. Keep your eye on this line. That's going to be the level or the top of the 15-minute buy side and balance, sell side inefficiency that the market drops down into on the Judas. So inside of the opening range, it's the 9:30 to 10 o'clock interval. That's this drop here. Okay, so it drops down into that high of that fair value gap on the 15-minute time frame. The market then rallies higher. Then we have this small little buy side and balance, sell side inefficiency fair value gap. After rallying higher, it drops down into that. And later on, you can see that it did, in fact, go higher. But again, that's outside of your model. Your model is to be completed by no later than 11:30 in the morning Eastern time. All right, 1-minute chart. Here's the sell side liquidity pool here. And here's that top of that 15-minute fair value gap. So we can see that the market did, in fact, open up at 9:30 here. We dropped down, rallied up, took out the short-term high. I'll talk a little about it again in a moment. Broke lower, came back up into this sell side and balance, buy side inefficiency, fair value gap, then drops and attacks this low, and then into the sell side, and then down to the top of that 15-minute fair value gap. The market then rallies up, creates a fair value gap here, accumulates new long positions, rallies up, comes back down into the discount wick, which is this wick right here. And this half of that wick is this level here, so it hits it perfectly to the tick, rallies, comes back down in, rallies aggressively into a higher high than that of the high formed ahead of 9:45. All right, here's regular trading hours. This is the time we look for the opening range gap. So that's the previous day's settlement price, 9:30 opening tick. You grade your price swing like that. And this is that 15-minute fair value gap, the high of it and the low of it, and then the fair value gap and the subsequent discount wick, consequent encroachment that we just looked at before we went into this regular trading hours. So regular trading hours, we had a huge premium gap, and usually when that happens, you have continuation going higher. All right, here is a 1-minute chart. You can see the beginning of the opening range start at 9:30, which ends at 10 o'clock here. So we had an opening bell, first print here. That's your opening price. It drops down, creates a short-term sell side liquidity pool, and the initial high is the initial buy side liquidity. So the market rallies up, which is what you see here in this little shaded box. Watch the recording because you can see me actually call this before it happens in the live stream. So I outlined this very thing happening, taking out the short-term high. Retail traders are going to use that to be a breakout artist and buy as the market goes above this high. That's a trap. So smart money will short there. So where retail is trying to buy it, smart money sells against that. So it provides them the liquidity to sell near initial high of the day there, and then attack the sell side liquidity down here, which is what I walked everyone through. I mentioned in this area here on the 15-second chart, which is the next one in the slide, you need to be aware of these multiple gaps. And you can look at the Model 2022 playlist to familiarize yourself with that. Not that that's going to be your model, but having a well-rounded, comprehensive understanding about how price books will aid you and assist you in picking fair value gaps that you're going to capitalize on. The very first fair value gap on the 1 minute chart is this one here. There's no other gaps here. So that's the first one. So that's what's noted here, first fair value gap. And this is a later one after we had the market drop away from the buy stops being triggered above here. This is the first return into a sell side imbalance, buy side inefficiency. Inside this gap here, targeting there, and then down to this low. If you look at this candlestick's low, I have this underline up here. I'm highlighting this candlestick. You can see that that is the time, the 9:52 a.m. September 19, 2024 candlestick. That low price is shown here, 19,963.25, and that's the actual low using this high to that low. So we're using a swing projection model on a Model 22 entry, attacking this sell side. How much further can it go? Down to the top of that 15-minute fair value gap high, but specifically to the tick, because the market's algorithmically delivered from high to low perfectly to the tick. And then watch in the live stream, I'll be talking about how you should try to look for $75 to $100 for one micro contract. So that's the equivalent of 37.5 to 50 handles in the NASDAQ, which if you consistently do that with one micro, when you get to the point where you're trading one mini, that's with 50 handles, that's $1,000 per contract. So that's a pretty good day. That's better than your job right now. So then we have the buy side imbalance, sell side inefficiency after creating that low. Rallies, comes back down in, accumulates in here with these wicks. This wick here, consequent encroachment. You see it comes down perfectly to the tick and rallies back above. Over here though, this gap, it trades up into that. I mentioned this on the 15-second chart. It breaks lower, and notice the midpoint of this buy side imbalance, sell side inefficiency. That's the very first fair value gap. So since we're looking for a run into mid gap, or the consequent encroachment of the opening range gap, the first 30 minutes of the trading, because it's a 70% likelihood it's going to trade to the midpoint of that gap, that means our initial bias is going to be lower. It does not matter what the daily candlestick's going to do. Your model is focusing on that. It has a built-in advantage, it has a built-in element of time, and you're picking the very first fair value gap to work with. So midpoint of that gap after it trades down comes back up in here and then sells off and trades down into top of the 15-minute fair value gap high, and using swing projections on internal range, the high, the low, perfect delivery to the tick. And that would complete your day. You wouldn't do anything else. And finally, the 15-second chart, just a little bit more detail. This is the gap I was mentioning real time. Watch the live stream. You'll see me talk about it, because it's this one here. And it was trading up into it. I said, watch, you can just poke its head into or stab into this gap here, which is what it does there. And I said, now we want to see if it wants to roll over and create this shaded first fair value gap, act as a inversion fair value gap. It means it's going to trade down through it, come back up, have a difficult time getting back on the other side of the upper half of it. And you can see it creates this distribution here, attacking the sell side. And when it's down in here in the live stream, watch and see. Dad's talking about how $75 to $100 is a good, target to hit for your trading in the beginning. So if you can consistently make $75 to $100 a day for one micro, it doesn't take very long for that to build up. And you consistently, if you can do it for 1 week, then you add one more micro contract, and you continuously do that. So it conditions you expecting to do the very same thing all the time, but allowing the leverage to slowly build, and not using a mini where it's $20 per handle in price fluctuation. This is only $2 per handle